Okay, excellent. I would like to welcome our audience to our webinar today. I'm very happy to be presenting to you on the topic of build to sell, creating a business that can thrive without you. Some of you are business owners. Some are those that aid business owners to help them succeed and to stay in business for the community vitality, economic vitality of your area, or even to provide jobs just for people. My name is Scott Bailey. I was originally in Iowa. I'm currently speaking to you from Minneapolis, Minnesota. I've spent some time consulting through Advanced Iowa after a 20-year career with Pella, and I will be drawing on some of that experience when I present to you today. Also, just a little bit about myself. My wife, Stephanie, and I have been married for 33 years. We have 4 grown children. They are all out of the home. 3 are married. And I was just talking with a coworker here before we got started about the fair. I always love going to the Iowa State Fair, and I make a point of doing that each year. And we just went a couple of weekends ago. I think it was the first Saturday of the fair. I have a son, Peter, who played the violin growing up in the fiddle competition. And so he still does that in the adult category now. And we bring our 4 kids, their spouses, and 7 grandchildren, which is pretty awesome. So I'm very blessed. And now that I'm in Minneapolis area, today is the first day of the Minnesota State Fair. And so supposedly the people around here tell me that it is better than the Iowa State Fair. And I'm yet to believe it. I have to see it for myself, so I'll be going soon. Currently, I am working full-time as a CFO for a Pella distributor here in the state of Minnesota. And so I'm back with the Pella family, but I spent 5 years consulting in central Iowa and working for Advanced Iowa, serving small business owners like yourself. So let's get going. I'm going to start with a question or two in a minute. First, what I'd like to let you know is that one of the significant services that Advanced Iowa provides to business owners in the state of Iowa has to do with succession planning or exit planning. The current model that they're using was developed by John Brown. John Brown was an estate planning attorney that had a large partnership, a law firm, and he found that he was constantly doing exit plan related documents for his clients. So he decided now about 15 years ago to write a book on exit planning and to start an association of professionals who are in this space of exit planning. Again, his name is John Brown, and they have a 7-step exit planning process. The organization's name is BEI, Business Enterprise Institute, and they currently have their summer conference going on. I recall the last time I was there in Colorado, it was about 300 people. These are estate planners, they're CPAs, tax experts, they're insurance guys, they're bankers. There are people that help in this space of exit planning. So I just want to give you a recap of the 7-step exit planning process and where the topic today is going to focus itself. The first of the 7 steps is for us to help an owner with their objectives. What do they want to do with the rest of their life? What do they want to do with their wealth? What do they want to do with regards to the continuation of their business? We then help them identify the gap between their expected results when they leave the business and where they're at currently. That includes assessing their personal financial situation and their financial goals. The third step is where we're going to focus, and that's on how to maximize. Excuse me, it looks like I have a process that's trying to run here in the middle of our presentation. I will cancel it. And then we'll continue. Here we go. I think we're back. So this third of the 7 steps has to do with maximizing and protecting the business value. So that's where we're going to focus today. After that are 3 different ways of, or actually 2 in this case, ways of transferring ownership, either internally or externally to a third party. Then there's the issue of business continuity planning, and lastly, the personal wealth and estate planning. So let's get started with how to maximize and protect the business value. In our last seminar, one of the slides that I presented on succession planning had to do with taking the buyer's perspective. Now, one of my clients in central Iowa, after we had done some work together, he told me about this book. Finish Big. And interestingly, that same year that he told me about this, written by Bo Burlingham, Bo spoke at the BEI conference in Denver. So I get to meet him personally and talk to him afterwards after having read his book. And I do recommend it to you. It is quite good. Here's a quote from Bo that I think relates to what we're talking about today. Bo said, "Build it to last forever. Build it to sell tomorrow." I want you to think about that. Talking about you building your business. Build it to last forever. So it's a business that will continue to thrive without you. Build it to sell tomorrow so that you're constantly ready from a buyer's perspective to provide excellent value to achieve your financial goals and to attract the buyer's interest in your business. John Brown, who I've also alluded to, he talks about the importance of working on your business instead of just in it as an employee. Quoting John, he says, "Change your role from hands-on and heads down to hands-off and heads up." Think about that as well. Change your role from hands-on and heads down to hands-off and heads up. So here, we're going to take a pause here. I'm going to take you on a mental journey with me, and I'm going to tell you a story. Of course, the question behind the story before I get started is, how well will your business thrive without you present, without you there to run it and make decisions for people and to keep relationships solid? So here is the question for you. Please imagine with me that somebody that's close to you has planned a 3-week vacation. They're not telling you about it, but they've arranged for you to be gone. They have you show up to meet somebody at an airport. They even convince you to go through the security gates. This is an old story, by the way, when you could go through the security gates without a ticket. They say that you have an old friend that can only visit for a few minutes, and they can't leave the airport. And so this friend of yours convinces you to go through the security gates to the gate where the friend is supposed to show up. But the friend has not come off the plane. So your loved one convinces you to go onto the plane because he's sitting on the plane waiting for it to take off, and he can't come off. So you walk on with your loved one onto the plane, and you still are unaware of what is going on. Well, before I tell you the end of the story, let me tell you that this was a real situation back in the 90s, the early 90s. My mother, her brother, my Uncle Frank, had a construction company, and he had a partner, and he would never take a vacation. The business relied upon him constantly to be there, to do the books, to do the bidding, to do the work, to oversee the crews. He would not take a break. So his wife and my mom, sister-in-law, they decided that they were going to convince Frank to go to Bermuda. So now let's go back to the story. They've got Frank and Barb and Phyllis. They're on the plane, standing in the aisle, and he asks, "Where's my friend?" And they tell him to sit down, that they're going to Bermuda for 3 weeks, and that there is no friend, but that he has the ticket, and it's all going to be great, and he can just sit down and relax. Well, what do you suppose was going through his mind? So, of course, I wasn't there, but I've heard this story told and retold several times, and he was actually steaming mad. First, that he was embarrassed that he believed them, and he went all the way to walking onto a plane, again, back in a decade when you didn't have the security protections that we have now that would not allow you to do so. And it took him the whole trip flying there to just calm down. And by the time they got there, he did have a good time. And the business actually did fine without him because there was advance notice given to his partner and things had been arranged and it worked. Well, the purpose for me asking you this question is for you to think, what if there was no advance notice and you did leave on a 3-week vacation? How well would your business thrive without you? You're not there to make these decisions that employees come to you with or that customers are asking for. This is the topic that I want to speak to you today, so please keep that in mind. In one of the chapters of Bo's book, Finish Big, and I do commend this to you. He gives a list of a third-party tool called the Sellability Score Factors. Let's just go through those briefly. First is financial performance. A buyer is going to pay attention to the cash flow of the business. Growth potential is also going to be important in the valuation of a business. Overdependence on a supplier or a customer. If you have one customer that provides, say, 30% of your sales volume, then that's going to be an overdependent situation. 10% less would be ideal. Same with the supplier. Cash flow of the business. How often do you have to go replenish your annual sales, or do you have repeat business? What is your market fit through your value proposition? What's your brand identity, and what do customers think about how well you satisfy them? And lastly, what is the strength of your management team? I've highlighted in red the first and the eighth, because the financial performance is something I'd like to speak to you today, as well as the strength of the management team. Let's take a look. Before we do, I want to restate those two, financial performance and management team, into something that might be easier for you to remember. There's a book written by Doug Tatum called No Man's Land, where growing companies fail. And his concept was the 4 M's. That is, he said that companies will often fail when they don't have a market fit or they've outgrown their marketing approach. This would be evidenced by a decline in sales volume versus a growing company. Second area would be outgrowing your management team. You know, it worked when you were smaller, but now that you're much larger, maybe they don't have the skill sets that you need from a management team. Third area is that of the model, and I'll be speaking to that a little bit more. What's the business plan, the economic model? And then the fourth M is money. That is the capital. Do you have the capital that you need, both in equity and in debt financing, to be able to run the company and to grow it? So this is going to be my learning hook before I go into now my next slide, which is on the learning objectives. Please just think of two things. First, the context in the question, just to reset the stage here, is will your business thrive without you? Will your business thrive without you? And we're going to look at 2 of the 4 M's. The first one is model. The second one is management. So now let's review what my learning objectives will be. With regard to model, I want to introduce to you a basic economic model and some tools for assessing how well you're doing financially. The second learning objective is that of preparing your management team to lead. There are 2 components of managing to lead that I want to focus on. First is the second in command, and the second is just executive decision making. So again, model, that's what we're going to focus on, the first one. I'd like to quote for you Doug Tatum in his book, No Man's Land. These entrepreneurs feel as if they don't know where the business is financially. They don't know whether they are making or losing money, or whether growth is improving the business or running it deeper and deeper into the ground. On a day-to-day basis, they feel like their business is operating on fumes, and they don't know where their next infusion of cash will come from. Finally, they feel a sense of heightened risk, as if every decision they make entails betting their personal financial future or the firm's very existence. Now, hopefully you can't relate to this and things are in order, but if you can relate to this, this is going to help. Now, we're going to pause on that thought on how an entrepreneur feels about the financial state of their business. And I want to take you back to one of my earlier slides about considering the buyer's perspective. Do you remember when you last bought a home? You were in the buyer's seat. You would have seen things about the home that you currently live in that you thought could be improved upon. But after you got 6 months into owning it, unless you wrote down a list of all the things that needed to be repaired or improved, you have lived with those issues for 6 months, and you likely are okay with them, and you no longer feel the need to make that change, or you'll have to make it at a future date. So it's easy to get out of the buyer's perspective and into the owner's perspective and not see the same things that you saw when you were the buyer. So I want to talk to you for a minute about what the buyer sees when they look at your business as it relates to your economic model, as it relates to financial performance. And so you'll see the graph that I put in here. And the question at the top, when do you break even? So I've shown a business that is seasonal in nature, that loses money during the first 4 months of the year, January through April, and cumulatively goes into a loss position, not getting out of that loss position until break even in August. 8 months. 8 months before it breaks even. This would be a concern to a buyer candidate. So I want to put a mark on the line on the graph here for you. So August is the point of break even for cumulative profits for the year. What does a buyer want? Well, they don't want to put the whole financial strength of the business in jeopardy for 8 months and then to make it all up in the last 4 months. Their goal is going to be to move the break even earlier into the year so that there's a greater probability of success, moving it to August, or excuse me, from August to April if possible. So a little math for those of you that don't regularly compute, what is the sales volume break even? The basic formula is your fixed cost. That would be your operating expenses for your general and administrative, for your selling and your marketing functions, for your IT and for HR, accounting, etc. Those are your operating or your fixed costs. Now you might also have some fixed costs in the whole operation side of your business, depending on whether you're, a service, a distribution, manufacturing type business. So anyway, the break-even volume is taking your total annual, or you could do it monthly, your total annual fixed costs divided by whatever your contribution margin is. Some businesses, they only calculate a gross margin, so I just put the word margin. So you take your total fixed cost divided by your margin, and that gives you what sales dollars you need to just break even, to earn enough margin dollars to cover your fixed cost expense. So in order to move that break-even point earlier into the year, to have a business that's a little bit more nimble and less risky, buyers look to do the following. They want to lower the fixed costs. There's a business that I'm familiar with that when the ownership changed, the new buyer came in and they cut a third of the head count. And they grew the business, doubling in sales over the next 5 years, and then also gradually increasing the headcount. The previous owner did not think that they could run the business without all those people. And they weren't making money. They were just barely breaking even each year, sometimes losing money. The new owner has actually satisfied customers better, provided greater job opportunities and growth for a larger number of people, though it took 4 or 5 years to get there, and is making money that is above the industry average for his type of business. So it is possible, and when a buyer comes in, they're going to look differently at the situation than you as the owner will look at it. But you can do something about that. You don't have to wait for the buyer to make the action steps. You can look at how you would lower your fixed costs. And by the way, if you take this buyer's perspective and you make the changes that are necessary, you might find that this business can run without you and you can continue owning it. Wouldn't that be a great situation? You got the golden goose that lays the eggs and you don't have to be the president to run the thing. So back to what a buyer looks for. Lowering fixed costs. Also, raising the contribution margin so that it's even easier to cover fixed costs, which, number 3, allows you to break even earlier in the year. So here are some questions that you should be asking yourself. What are your monthly fixed costs? What's the nut? Do you know? Is it $100,000 a month? It's a number that you would average throughout the year, and it probably doesn't change much month to month. So what is the fixed cost nut that you have to cover each month? How much of that is payroll? You should know these numbers. They should be top of mind. What is your gross margin rate as a percent of sales? And how does that compare against the industry average? Another metric that I find quite helpful for managing a company is to know within your industry, what is the average sales volume annually per person in the business? So your sales dollar per employee. This can help you with some of your executive decision making about headcount adds. Here are some other questions that a buyer would ask. I think they should ask, and that you can ask yourself. Who can do a weekly cash flow projection for you? And how far out can they do it? It's a practice that I do for each of my clients and I do now as a CFO. I track each week's cash flow into summary buckets. The most summarized are cash disbursements and cash receipts, but there are some subcategories below that I like to look at. This allows me to look out and do some cash planning, working capital planning. Second question, who can forecast month-end profit for you and how accurate are they? Can they do it within plus or minus 10%? This is a helpful skill set for people to have, and I would encourage you to work in that direction. Third question that I would have you to ask is, describe your decision-making process of when to add fixed costs or fixed assets. So this has to do with capital. Say you need to buy a new delivery truck, or someone else wants a company vehicle, or you need to expand on your warehouse or your office space. And so now you need to spend a chunk of money that the government's not going to let you expense all at once, for the most part. They'll have you depreciate over time. These are capital investments. How do you go about making those decisions? We're going to talk about that a little bit more later in the presentation. So good questions to ask yourself about your fixed costs. Buckminster Fuller, you never change things by fighting the existing reality. To change something, build a new model that makes the existing model obsolete. So do you have a financial model or an economic model for your business? Most owners do. They have it in their head. But if you want your management team to help you run the business, they need to know what this economic model is so that they can also track with it and try to help you manage to it. So here's an example of what I mean by an economic model. And to quote Doug Tatum, when I speak of a business model, or as some call it, an economic model, I mean something quite specific, an analysis in financial terms of how a business makes money. So here's the handwritten whiteboard sample model for you. We're looking here on the top. It says models, sample model. On the left-hand side, you'll see P&L. We have the revenue, cost of goods, gross profit, operating expense, and operating profit. In my example, I show a $10 million sales business with $1 million operating profit. It's good to understand that as a percent of sales. So 1 million of operating profit divided by 10 million in revenue is a 10% return on sales, 10% ROS business. Now, if we were to break the business up a little bit in say, construction, they have hard bid situations and they have negotiated bids. And they earn a different amount of gross profit depending on whether it's a hard bid or negotiated bid. So it would be helpful to have those models in mind when you put yours together based on a customer segment. Now, look at the bottom half of the slide, the balance sheet. What investment in assets does it take to support a $10 million revenue business? In this example, it shows 40 million. 40 million is, you could put that in a ratio or a relationship to revenue. So that's 40 million to generate 10 million a year in sales. That relationship is a 4-to-1, obviously. 4-to-1. What if you could generate, you had an economic model where you only needed $30 million of assets to generate the same $10 million in revenue? That would be a better ratio for you. It would cost you less to invest in that business. Buyers will take a look at that. They're going to take a look at something that's called the asset turnover, which is sales dollars divided by asset dollars. So this is what I mean by an economic model. In the appendix section, I have some more detailed examples that will support this concept. To teach people, though, continuing with Buckminster Fuller, if you want to teach people a new way of thinking, don't bother trying to teach them. Instead, give them a tool, the use of which will lead to a new way of thinking. So I want to give you a tool that is used by Advance Iowa that will help you take a look at your financials. First, I'll step back. When I used to work for Pella Corporation, they would bring some medical staff on site and we would have a wellness checkup. Almost everybody in the company signed up for it, and they would move us through just one person after another through different stations. And in the end, they would give us this handwritten screening result that looked at our cholesterol, good and bad, looked at our BMI, our triglycerides, and looked at a number of different things that are important for them to calculate mathematically, scientifically, how healthy we are. And then I would get a predicted age based on these indicators of your health. They would tell me how statistically old I was. And it was never good when that age was actually greater than my birth age. I started to think about this health screening approach, and I realized, you know what, this would be helpful to have a tool like this to look at the financial health of a business. And so we developed one. This is a quick look at what that is. This financial health screening tool looks at the three primary financial statements. The income statement is in the first section that you'll see in the red box. The second section has to do with the balance sheet, and then cash flows and return on investments. Let's look at this a little bit closer. So here's that red box blown up. It tells us, are we growing and are we making money? Well, compared to what? In this case, we're comparing it to a like business or the industry. Well, where are we getting that industry or like business information? We're getting it from a source called Fintel. I think they have a different URL at this point, but it's the same company. Once we get that information, we're able to put it into comparison to how the current company that we're doing the financial health screening for is doing in that category. We move on and we do the same thing for the balance sheet. On the balance sheet, we're asking the basic question, are your assets productive and are they paid for? I'll bring to your attention the rightmost columns. The right column is the actual results. This goes back a few years when we were designing this to begin with. In 2014 results for a company. The column to the left of that, called current results, is what gives just a stoplight color, red, yellow, green. Is this annual financial result good, bad, or great? Is it green, yellow, red? And we do that in comparison to, you'll see the category column that says what value is optimal, what value is average, and what value is at risk. Those are the same type of categories I saw in my personal health screen report when that was being done for me. And so we've applied the same logic, the same approach to a financial health screening. The third section has to do with cash flows. Here it is blown up. We're looking at things like, what is your cash flow, return on investment? What is your EBITDA? EBITDA is an important concept that business owners and buyers understand, because it represents cash flow basically. It's earnings before interest, taxes, depreciation, and amortization. Typically, when someone says that they bought their business at a 5 multiple, what they mean is 5 times 1 year's EBITDA, or 5 years of cash flow from the operation, excluding the costs of depreciation, interest, taxes, and amortization. So anyway, we take a look at what is the industry average, what is a like business, and how are you doing? In this case, we show it red, at risk. It was at 4.9%, whereas the industry and a like business was doing 10%. Ouch, that hurts. So if that's the situation, you want to ask yourself, okay, well, what's everyone else doing that's getting double the kind of EBITDA that I'm getting as a percent of sales? This is the health screening tool Advance Iowa offers to help businesses like you. All right, we're halfway through our learning objectives. We've looked at the economic model. Next, I'd like to take a look at the management. So back to the 4 M's and Doug Tatum's No Man's Land. Where growing companies often fail is when they outgrow their management team. What's your situation? Think about it. The people that you have in place, have they been there a long time? Did they start on the ground floor and work their way up? Do they have the kind of management skills and professionalism that you need at this point in size of your business? And as you think about doubling your business and going forward, are they the people that can take you there? Do you have the right management team, or have you begun to outgrow it? I want to take a quick departure here and talk about successor selection. And I think it relates to this whole concept of your management team and who's at the top or who's second in command. And I'll explain why in a minute, but bear with me to take this quick exit, this tangent. First off, when you think of eventually leaving your business, there are two terms that come up, and I wonder which one fits you best. What do you mean when you think of exiting your business? Is it succession planning or is it exit? So here's the definition that I'll offer to you. Succession planning has to do with focusing on developing leadership bench strength. Of course, that's the topic that we're on, management team. So succession planning is leadership bench strength to achieve a smooth transition in the management of the company. Exit planning, on the other hand, prepares the owner to step out of management and cash out ownership. It includes succession planning to ensure business continuity as well as the efficient transfer of wealth. So we're talking about the management team and whether you've outgrown your management team. And so there are some concepts or practices that I would like to share with you briefly that talk about selecting successors. Now, even though the slides say successor selection, think about leadership. Think about this succession planning definition. You don't have to give up the ownership of the business to do succession planning. We're talking about leadership. So successor selection process. First is, are you even ready to consider that? It's the owner's exit readiness. If you really don't want to leave the position of being the president and running the operation, it's kind of hard to think through this. So substitute in your mind, if that's not you, if you're not ready to find your successor, substitute in your mind second in command. It's a really important concept that helps you to still be in charge, still run the show, but have somebody else that can carry the weight when you leave on that very short notice 3-week vacation to Bermuda or wherever better you have of mind to go. So the next piece in successor or second in command fit would be who says or says who. In a company where maybe you are 100% owner, so I guess it's just you. But I bet you there's some other people that you care about what they think that are influential in making that decision. In other cases, there's more than just one owner, and you do have a board or you have other shareholders that you have to have agree, a partner. So it's important to know who is going to contribute to this decision of the second in command or the successor fit. Third input that's important is where are you in your business cycle, the life of the business? Are you still expanding it, trying to develop a stronger distribution system, expand your customer base? Well, your second in command, maybe it needs to be someone that's really strong on the sales and marketing development side. Or are you towards the later maturity of your business, and it's one of just running the existing business efficiently? Well, maybe in that life cycle of the business, you need somebody that is better at HR or manufacturing or operations type things. So think about where you're at in your business cycle when you pick your second in command or potential successor. The next input that you should consider is that of your strategic plan. And the question is more basic. It's, do you want your second in command, or in this case, your successor, to determine the strategic plan and create it for you? Or are you going to create it and you want them to run it? Since we're talking about second in command, we'll go with the latter, that you have the strategic plan, you're still in charge, you just want a backup person to be second in command, and you'll give them the strategic plan to execute. Then there's the candidate assessment. Are they ready to take on this responsibility? Do they have the basic wiring to lead as second in command or eventually as successor? There are some assessment tools that I'll show you that are in the back of this particular slide deck. And if we don't get to it, it's something you can read later to prompt your thinking on that topic of doing an assessment. Then, of course, and I jumped the gun on this one, readiness of the candidate. Maybe they're wired, maybe they're just not ready. And so what experiences do they need to be able to step up to that role of second in command or eventually as a leader successor? Here's another tool that a larger company has used. They actually had two candidates in mind to be that next leader of the business. And so they had two columns and they ranked each of these personal characteristics, experience, and skills, and whether the candidate was strong or still needed development or they had some kind of a barrier. And so it helped them to decide on which candidate to go with. And frankly, they ended up developing both candidates at the same time with the goal of seeing, who would succeed and come out on top. Not a bad idea for you as well as you pick a second in command. All right, so we've talked about in the leadership or the management, the second in command concept. The last one I want to cover is that of decision making or executive decision making. So back to the 4 M's to ground us. There's market, model, management, and money. We're on the management M. Let me use fixed costs. Adding fixed costs is one of the executive decisions that are made. Let's say an employee, a leader in your business comes up and says, it is time to renew our fleet of trailers or our fleet of vehicles or our showroom or our main office. And so we need to incur this cost. Worse yet, they say, you know what, it's time to add some more people to our management team. And it'll take us about 3 years before we grow to be large enough to be able to afford that fixed cost investment. So do you have the financial wherewithal to make it through the next 3 years while we drive up our revenue to cover the additional cost of the key managers that we want to put in place? And oh, by the way, we need these key managers in order to get to that sales volume target that we're talking about. So Tatum refers to this as no man's land. If you add the fixed cost, there's this stair-step effect going from something variable or less fixed cost to a much higher fixed cost that might put you into a loss situation. And it will take you a period of time to get the revenues up to be able to absorb that fixed cost and still be profitable. And he calls that his no man's land, thus the title of his book, and why companies that are growing fail. So the question then is, how do you make this decision to add fixed cost? I propose to you that there are 4 different methods of making a decision, and I'm summarizing them for you with these single word titles. This comes from Crucial Conversations that is decades old now, and I found it to be exceedingly helpful. One of the chapters talks about communicating to others in your organization how you plan to make a decision. The first is command. That is, I'm in charge, I'll tell you the answer. Command. The second executive decision-making approach would be consult. Okay, I have an executive staff. I'd like to find out what you think. I especially want to know from the expert in this particular field. Maybe it's the CFO, controller, if it has to do with adding fixed costs. Consult with me and give me your recommendation. But I'm in charge and I'll decide. That's consult. The third approach to decision-making would be that of voting. We have a team of, say, 6 people on our management team, and we need a majority, a simple majority, to go forward with this. So we're going to discuss it together and then we'll vote. And a fourth would be, we are not moving forward with this decision at all unless we have a unanimous consensus to do so. And that would be the consensus approach. Which of these methods do you use in your business? Have you trained others to help you think through this? When you make an important decision or you're about to make one, do you let your audience know which approach you're going to use to make the decision? This could really affect their buy-in, their willingness to support the final decision. Because if they think that your approach is going to be one of vote or consensus, but it's command or consult, they will be disappointed and they will likely not want to give their input in the future if you didn't take what they thought you should do and go with it. So thinking through your executive decision-making methods, and you use different methods for different decision-making needs. But it's helpful to train your people so that they know how to communicate and use these different decision-making approaches. One of the assessment tools that I use is called ProScan. They're actually based out of Colorado Springs, Colorado. Um, One of the things that they look at is logic. And so I'll bring your attention directly to that. They actually measure through these questions that are asked how a person goes about making decisions. And often people have an intuitive gut sense. Doesn't make it wrong. It just means that in the absence of facts, they don't feel stuck or frozen to make a decision. They recognize patterns quickly. They have previous experiences that they can draw upon, and they can just make a gut instinct call. A lot of entrepreneurs have to deal with vague things. They're developing a new business, maybe in a new market, new product. They have to use this approach often. However, it's the same approach that can get them into trouble. And it's helpful to have a second in command or others on your management team to rely more heavily on the facts to know that this is a good decision and they have logical reasons to believe so, and they've done the homework to find it out. It's helpful to do that. Maybe the last new concept I want to bring to you is, it's an old concept. We see this all the time. Unfortunately, it's viewed by smaller companies and entrepreneurs as just bureaucracy. These concepts are often thought to be for large corporations, and they're just in the way. They're not helpful. But I would submit to you that having a mission and a vision and a statement of values helps you train people to be on the same page with you so that you can protect your company culture and you can get people to buy into where you're headed. And so instead of having people try to interpret your behavior, to anticipate your way of thinking without a stated mission, vision, or values that you'll operate the company by, people learn faster if you actually tell them. They don't have to just read you to figure it out. And it's a form of early decision making. We've already decided how we're going to operate this company and by what values. And if you don't fit with those values, then we need to talk about it and give you the chance to change. And if you don't want to change, we probably can't work together. Then company policies. Now, policies can also be helpful. They don't have to be a burden. They actually are a way of deciding in advance how you're going to decide on stuff. For instance, one policy might be, what is your spending authority? One level of management would have less authority to sign and approve an invoice than someone that's, say, the president and owner, or the CFO, or the VP of HR. So putting certain things into company policies is quite helpful in making decision-making easier for your management team. There's strategic planning. That certainly helps make some key decisions on how you're going to go about growing the business. There's the economic model that we've talked about. You know, if you give people certain boundaries, like we need to make profit that's at least 5% of sales on average, and if you want me to invest, I can invest if we make enough profit above that level, but that's the minimum I need to cover my debt service costs and to take this risk as an owner. So it's nice to have some economic models to help with executive decision making. Then there's budgeting and forecasting. Of course, when someone has a budget, you ask them to try to stay within that budget. Say it's a marketing budget, and they could overspend it, and that might cause you to lose money for the year. And maybe that's not a loss that you can afford to finance. So staying within a budget helps with decision making. And then there's that of just accountability and giving feedback to improve the culture of your business. All these things help in governing decision making. And it would be nice if you had this in place when you were gone on that 3-week vacation, or if you leave for, you're a remote owner and you're not there every day to preside over it. This will guide the decision making so that less has to be moved up to the top to get your counsel. So we've talked about both the management M and the model M. I think we've covered our learning objectives, and I want to move in a minute here to a time of Q&A for you. We have a few minutes left, but I want to remind you of things that I've already shown you here. First, the question to you is, how well will your business run without you? John Brown, again, his counsel was change your role from hands-on and heads down to hands-off and heads up. Bo's recommendation to you, and I love this quote, build it to last forever. Build it to sell tomorrow. And of course, that was our topic today. How well will your business run without you? Will it thrive? At this time, I will take some questions from the audience and try to answer them as best I can. You can use your chat box to submit those, and Sarah, I believe, will read them to me one at a time if there are any questions.
Yeah, so right now it doesn't look like we have any. So if you do, go ahead and put them in the Q&A box and we'll get them read off.
While you're thinking of your questions, I'll just scan quickly through the appendices in case there are things there that pique your interest that you would like to look at later. So John Brown, this is the book that he wrote. I believe you can get this through Advance Iowa. Exit Planning, the Definitive Guide. He has several handouts that I think are helpful. This one had to do with value drivers of the company. I think that checklist might be helpful for you to do a quick self-assessment. He also has something on avoiding deal killers when you go to potentially sell your business. That'll help you to prepare better and think like a buyer. Preparing for the unexpected. There are other books that help with thinking through what's the basic information that a new buyer will need to get started. Here's some more slides on the economic model, some inputs for the P&L, as well as for the balance sheet, and then the resulting cash flow statement. With regard to assessments on people, I particularly like the ProScan tool by PDP Global. They help you motivate right, select the right team, hire right. Here are some other assessment tools. There's the DISC, Myers-Briggs, PI. There's Talent Plus and PDI, ProScan. There are quite a few out there. Some are in the $100 range per survey, and others are much more expensive. Let's go back to the Q&A slide and find out if there are any questions at this time. How are we doing, Sarah?
Doesn't look like we have any questions.
Okay. Well, then I would like to thank you all for paying attention to this webinar. Please feel free to contact Jane Keelman or Dan Binkin or myself if you have questions about the presentation or if you'd like some additional assistance from Advanced Iowa. Have a great day. Thank you.